for those who may not know me, my name's Jeed Baroni, just one of the partners here at BDH Leaders, and I'd like to welcome you along to one of our webinar series, which is, and this one, as you can see, is titled Achieving High Yield at Low Risk. We're very lucky to have someone very experienced as Adrew, who's a director of Semper, and he is going to, present to us and sort of let us know, sort of alternative investments and ways that we can achieve a higher yield at low risk. And we're in a very changing environment, as everyone knows. Yesterday we had one of the largest increases in interest rates for 22 years, I understand, in one month. So we're in a changing environment. Just to let you know, this is just part of the seminar series and webinar series that we do. We like to get experts in their field and just provide some investment alternatives to our clients, our wide range of clients. So I'll let Adrew introduce himself. As I said, he'll do a much better job at it than me. And then we'll get underway now. So Adrew, all up to you.
Thanks. I think we might go straight to the next slide, which is just so that everybody knows we're doing this in tandem today because, as with all things post-COVID and COVID, we've had some technical issues. But if we go to the introduction slide, we might start there. Just a bit of perspective on the background before we look at Semper Capital, perhaps, or Semper as it is today. I had been involved with EY for a number of years, and I arrived in Australia in 1999 after 12 years in Asia. I was an expert group advisor to the UN on regulatory reform, but it was as a partner of EY, Ernst & Young, and CEO of their international ratings business that I arrived here. I developed with EY a platform for rating subcontractors involved in that sort of perpetual process of resubmitting capability statements to large infrastructure suppliers. It was an online maintenance and reporting process back in 1999. But then, of course, the dot-com crash occurred, and we entered that uncertain world of Y2K, and confidence in future online markets fell. I didn't really want to be around with EY and wait that out. And I was looking around for other opportunities. And at that point, I was buying a property, and I wanted to sell the property I was in. And I was looking for some bridging finance, and I was horrified at the rates, and I was horrified at the process in what was a largely munificent and unregulated market. So I decided that I would take the lessons learned and build my own platform to lend my own money. And that's how Semper began, founded in 2015 with my own proprietary risk and investment management systems. Pretty soon I was managing money for finance companies, super funds, family offices. That's when I started managing funds for the Costa family, which came in 2011. And it's perhaps worth spending some time talking about who the Costas are, because for those that don't know them, I think people in Victoria will have a very good idea, but perhaps not so much in New South Wales. So Francesco, as I understand it, arrived very humble beginnings in 1895 and set up a small grocers at Mirabel Street in Geelong. I know that's where it was because they bought the building back only a few years ago to set up as the corporate headquarters. Over the decades, the family grew. They started investing using, I suppose, that old Chinese proverb that the best time to plant a tree is yesterday and the next best time is today. So they began vertically integrating their grocery business by buying land and producing fruit and veggies. And that grew and grew and grew into the 70s and the 80s when they then had their first wholesale stall at the Melbourne markets. And by the 80s and 90s, they were supplying 60 to 70% of all fruit and veg to Woolies and Coles. A magnificent story of perpetual intergenerational success. but it was in 2016 that they went through their first IPO. And I was very proud when Rob Costa came to me after we'd been managing money for them for only 5 years and said, look, is there something more we can do? Something that is fairer. And as you'll see here, let's do something bigger to bring mortgage market fairness to the residential mortgage-backed securities and commercial mortgage-backed securities market. And it was an intriguing question because at that time I'd been working on some mathematics to change the way in which capital adequacy worked in mortgage investment. And let's not get down that rabbit hole, but we launched in 2019 with the Costas, and we wanted to develop a world-class end-to-end mortgage origination and securitization platform, something truly transparent. And today, we're only 3 years into a 5-year plan to create a truly liberal, transparent, and liquid secondary market for mortgage secured and asset-backed fixed income investments through that platform. And you are very much the first to be introduced to that. We might move to the next slide. When we looked at the market and saw what the problem was, really, it is that Australians lack access to a liquid active bond market. I mean, there clearly is a very shallow bond market here. It's restricted mainly to you've got the sort of the top end market, which is the institutions, large institutions, but the buy-in ticket is very high. Then you have the trash bond market, which is highly risky. There's nothing that sits between that, which makes it truly difficult to balance growth strategies that come from investing in equities, for example, with annuity strategies, which are designed at not so much risk on the investment principle, but in achieving an annuity, a fixed income return. And that's what you get, of course, from bond type structures. Property is permanent, but we call it perishable if it's not promising. In other words, if it's not going up, it's either flat or going down, and it's largely illiquid. The stock market is liquid, but it's volatile, and particularly at the moment. Annuities that are asset backed, though, they have a certain value that should sit in everybody's investment portfolio. So with the difficulty of investors diversifying their investment portfolios and the inability of private and SMSF investors to get access to well risk adjusted returns, the size of returns that are smaller ticket items, that was the closed market conditions that we found ourselves in. And we thought, well, how do we improve this? Let's go to the next slide and look at a solution. Our approach was, let's turn Semper from being a lender. It's a good lender. It's never lost a cent. No, and we even through the whole COVID period, we did not have one loss, not even one client that failed to pay interest. And that's mainly because we're a conservative lender to businesses that are either growing or businesses that might be in decline that need support while they're selling down assets. But we wanted to create an investment situation which benefited by the opportunity to sit behind a family office, sit behind Costas at first risk on a truly transparent and simple to use platform. And I'm just going to take you through this because the Semper Diversified Mortgage Investment Platform, it's an online homogeneous origination market. And what we mean by that is every single loan is originated on it, managed on it, fractionalized into investment particles, small sub bonds, let's call it, and offered to investors to participate. But the Costas keep the top 10% of every single loan. So they're first in and last out. That means that when we're looking after their money, we're looking after investors. So they place, they originate all loans to an exacting principle and then place 90% of the funds onto the market for onward sale to incoming investors. This sort of improves the confidence we think of investors. These pre-funded loans with Costas holding top 10% really gives that kind of trust element that people need. And the highest loan we do is 70% at the moment, and we don't see that changing, which means that the highest ever exposure that investors would ever have would be 63. that's in concept. The truth is our weighted LVR across our whole portfolio is only 59%, which means that only 53% would be the maximum exposure. But we might stay on this slide and just talk about what we applied in terms of our lessons from the past. We went through the GFC, and we know that the GFC taught investors the meaning of the word CDO, or collateralized debt obligations, which is the pooling of mortgages and selling them as bonds. But it's a truly intransparent or non-transparent process. We learned about adjustable rate mortgage ATMs, and domestically here we saw the demise of former mortgage debt issuers, Bridgecorp, FinCorp, ACL, Banksia, Gippsland, and these were failures through a regulator falling asleep at the wheel, really. But after the GFC, ASIC brought in RG69 and how to improve the lot for investors in debentures. Those old investments were far too complex and too secretive. But taking all that we knew about the failings of pooled mortgage schemes and the closed nature of RMBS and CMBS markets, we combined these experiences with three very important things. One, that end-to-end transparent platform that acts as a single source of truth, and that's the important thing for all stakeholders. Two, was a very unique Australian financial services license that gave us a very unique investment offering. We were able to build something that I think is truly unique for investors. But as I said, this is only phase two. Phase three is moving to retail investors, which is happening in August, and phase four next year, which is listing all of our mortgage issuances onto the ASX to create a secondary market. And that really means that we can then extend from what are currently shorter term loans to businesses to longer tenure loans, because investors can come in and trade their way out of those opportunities and create a truly liquid market for longer held securities. Let's then look at the marketplace. If we can move to the next slide. I hope you can see this on your screens. We'll send you a direct link to the marketplace after this, and we can help you set up accounts. There's video demonstrations on how that can be done on the website, and we'll attach them to the email. And Jamie Mazzudier, who's our distributions manager, he will assist with concierge onboarding for anyone. If you're like me, an ill-tempered middle-aged man with very little patience, but it's a very simple process. You log on, you set up a password with an email, you confirm your ID, then you confirm whether you're a sophisticated investor or not, and most of you that are will be able to get that certificate from TAS, and you upload those, wait while we confirm the back end, and then you can come in and you will see this. These are two living loans. They are two loans we've pre-funded, and they are loans which are completely up to date, as I said they all are. And as you'll see, what you're presented with is you get a first picture. If you drill down to more, you can see more about the properties. You can see the loan amount, the LVR exposure, the term of the loan. You can see the term remaining. And that's important because some investors will want to come in and spread their positions for 2 months that are maturing, 5 months, 6 months. The longest we lend to borrowers at the moment is 12 months, because that's the market in which we play, with low risk, businesses growing, as I said, or businesses declining and selling down assets. And this gives you the return as well. It's a fixed income return. Here there's 5%, and my eyesight's failing me, and I'm in denial over the glasses at my age, but 6.5% on the one at the bottom, nice exposure. But if you given that the weighted average exposure across our portfolio is about 59%, getting 5 and 6% returns even today, I think for the risk is very, very comparable to top-end bonds to large corporations that are paying 3s and so on, or trash bonds, you're getting 7s and 8s, but you've really got no underlying asset. And it's important that you understand that as part of our license, every single mortgage is wrapped in a subtrust. It's not a pooled scheme. That means that that subtrust owns the right to receive that contract income and owns the right to collect against that property. And it is that subtrust that issues out the securities to investors. So investors have that link directly through the subtrust to the issue, to the mortgage and to the property, and it's unbreakable. It's not pooled. It's not like the CDO market. It is an absolutely transparent and connected investment. In our marketplace, investors, of course, can highly diversify. And this is just for now, really, they have a vertical exposure. By August, we are slicing up our loans by LVR, which means that investors can come in, they can buy a low slice at 0 to 10% with a lower rate of return, but very, very significant asset coverage, or they can choose higher levels with higher rates of return, but less coverage. But still, we keep the top risk position for costers. Let's take a look at some investment selections in the next slide. Minimum investment is $10,000. Maximum single investment is $500,000. It's fixed income, fully asset-backed, mortgage secured, sitting behind cost at first risk, which is always worth reiterating. Here, there, you can look at your own leisure. You'll see the LVR exposures, the terms and the rates. You can expect these rates to start climbing, of course, because as rates go up, our loans are about to be attached to RBA rate as well, and investments will be by about November as well. So as the RBA rate goes up, the borrower rate goes up, the investor rate goes up as well. When you come into the market, you're not obliged to invest. There's no cost to join. You won't be hammered by emails after joining. It's a proprietary system. You don't even have to set up a cash account with us. If you choose to dip your toe in with an investment, you get a special BPay code, and that comes straight into investment. Doesn't even come into the Semper account, goes straight into the trustees and acquires notes and retires Semper's notes. It's an immediate transaction, and that has been stress tested. It has been penetration tested. It's bank grade system sitting on Salesforce with our IP. And these are real examples of investment opportunities. That is pretty much all I've got to say, except perhaps to introduce you to some of the team in the next slide. Obviously there's myself and there's Jamie Distributions. Jess is the loans operation manager. We are about to appoint a CEO in July, which we've been trying to get on board for several months. We'll announce that in good time. And the next slide gives you our board of directors. Good old Rob Costa at the top there, of course, being our chairman. Now, he's a man that's very busy because he's a philanthropist, he's an environmentalist. He just took on the fake honey supplies into Australia because he says, you know, if people aren't buying honey, people aren't keeping bees, and if we're not keeping bees, we're not keeping our plants. He's a great guy. I love him to bits. He's a great avuncular fella. Lisa Whitmore is the CEO of Costa Asset Management. She's also on the board. Adrew Hahn there is also one of our RMs, and he actually worked with me 30 years ago in a company I sold to the Economist intelligence unit. Came back to join us almost 30 years later. The last couple of slides are really our obligation to you to talk about risks under our license. If you walk through those next two slides, and then we get to the disclaimer, and then our last slide, of course, it ends with an opportunity for me to take questions from anybody. And thank you very much for listening.
Yeah, so thank you very much for that, Andrew. So we've got a a chat box on the side. I think you can raise some questions if anyone has any specific questions.
Can I see that, Geet? Is it just you?
I'll check to see if you can see them just in the chats.
Let me have a look. I've got 2 chats. All right, here we go.
They should pop up on the right-hand side.
Yep.
Yeah. So if anybody's got a question they want to type that in there, we can
see somebody's.
Yeah, you can read that out. So
Tass, make sure that you write slowly because I can't read very fast.
And look, if anybody doesn't want to ask a question, doesn't have the opportunity now, you can see the contact details that are up on the screen as well. So you can always contact any of the partners here or your contacts here at BDH Leaders, as well as you've got Jamie's numbers and email addresses on there as well. So
there's an interesting question from Tass. Thank you. He says, with the uncertainty in asset prices and the economy in general, are you expecting returns to investors to increase over time? Yeah, that's interesting. If you think about the inverted yield curves on bonds as well. Yeah, you're going to see a contraction of asset prices as interest rates rise. I mean, I think it was just a 25 basis point rise in 2008 after Labour distributed, I think it was $700 to $900 to everybody. It had an inflationary effect, and that was borne mostly by mortgage holders whose rate went up by 25 basis points, and the property market dropped 10%. It returned pretty soon afterwards. So there is a direct correlation between interest rate rises and asset value declines. This is well understood in economics, and we've had a burgeoning property market here for 30 years. But what we're finding is, obviously, we're shorter term exposures. We're finding that valuers have already started to discount property prices. We've had assets revalued in just the last 6 months that have been discounted down already, although 1 or 2 were asset sales and they sold at the former price. So we know that valuers are getting ahead of the game with a great deal of caution. And we, being pegged to interest rates as well, we have to make sure that our return for investors is at least 300 basis points above, let's say, 3-month deposits, even though they're asset-backed, mortgage secured. They're in a different class. So we do expect returns to rise, but we also expect ourselves to be a little bit more cautious in our approach on property.
Okay, so Mark, I think Marcus has got a question here. So, what was the time frame for the potential access on ASX for those investments that you mentioned, Andrew?
Yeah, well, we're in discussion with 2 exchanges already. Obviously, it is to create a fully democratized RMBS or CMBS market is very exciting for us, because it means that we can broaden our lending to retail clients. Because we're basically pre-securitizing every single loan, it means that we can offer lower rate loans to lower LVR clients, which is something the banks don't do. So many benefits of having a fractionalized pre-securitized platform of the nature of that we've built, but it takes time to get these things through the regulator. And I would imagine that the secondary market for our product will come either towards the end of 2023 or in the early part of 2024. But right now, if liquidity is your concern, you can pick short-term cycles of 2, 3, 4 months, different loans, and then you're seeing your return of capital for reinvestment.
Okay. So we have another question. If an investor notifies you that they wish to exit, what is the delay to settlement / transaction day?
Investors buy in for term. So currently, these are if you invest in a loan that has 5 months to run, you're in it for 5 months to run, unless there's claimed hardship. There are hardship provisions that enable us to buy back those positions into the warehouse, and that would be a 24-hour cycle. But otherwise, this is not a pooled scheme. You're buying into the loan for the term of the loan until they're listed on the ASX. But as I said, they're very short tenure. The longest investment you could have is 12 months. And again, if you really want to make sure that you have, people will trade fungibility for rate. So pick loans that are going to cycle out in 2 or 3 months so that you're sure of a higher degree of liquidity. Let's just check that answers the question for Daniela. Maybe a thumbs up, Daniela. I don't know if you can do thumbs up in here. You can do a smiley face, I can see that.
Okay.
Yep.
Okay, so we've got another question.
Yeah, thanks, Daniela.
Yeah. So when a distribution's paid, I assume at maturity, is that correct?
Yeah, no, well, we pay interest monthly. So the interest is paid monthly directly into the account, unless a loan is in default, and then we have the right to you'll get a default interest is higher, but we will then accrue that. We have to act within 90 days. But generally speaking, we have the Costa Warehouse has the right but not obligation to take out loans in default, and because we pursue the higher rate of interest, and it's good practice. It's very rare for us. I think in 20 years we've had 4 mortgage in possessions, nearly 17 years. Then yes, we've had 4 mortgage in possessions, 2 of which were voluntarily surrendered. So it's very rare for us to have situations of default. We're very cautious lenders.
Okay.
But just to answer that again for Marcus, it's a bond-like product, right? So when you buy a bond, you obviously the face value is the amount you invest. The coupon is the interest rate you get on the face value, and it has a redemption date, which is the date at which your investment is paid back. So you get the interest rate on the face value until the date that the bond is paid back, and then you get your money back. So that's how it works.
Okay. All right. No, thanks, Andrew. So if nobody has any more questions, as I said, all the contact details are up there. You've got all the information on there. So if there's a question that comes up later, you want to send through an email or give us a call, feel free to do that. I'd like to just thank Andrew, particularly for putting on this presentation. Thank you very much.
Thank you.
Very interesting and very topical, which I think is good too. So I suppose over the last several years, people have been looking for ways to try and increase their returns, but in a lower risk environment. Obviously, we know that there are high yields in high risk, but we thought this would be a very good thing to put forward to clients as something that they can have your money working for you. So.
No, thank you very much. Thank you for the opportunity. As we said before, Australians understand property and they understand mortgages. Now they've got a chance to invest in mortgage and property-backed assets. So that's but thank you very much for the opportunity to present today, and thank you to your clients.
Yep. No, thank you. Yeah, we're trying to keep this on time. So thanks very much for everybody for joining. If you've got any other topics or anything else that's of interest to you, yeah, please don't hesitate to send them through to us. We try and find the expert in the field of what our clients' interests are and what we believe is something that would be interesting to them on a topical basis as well. So, but once again, thank you, Andrew, and also the team there at Semper for putting all this together. And we look forward to catching up with everybody on our next webinar, which we will send through to everybody. So thank you very much.